Welcome to Citigold series on all things investing. On this episode of Demystifying Wealth, we're covering investment bonds. When you buy or sell bonds, you're effectively buying or selling the debt or part of the debt in an underlying loan relationship, the price of which is based on the credit rating of the issuer of this bond. There are a few firms that evaluate and assign bond ratings, Moody's and S&P being the most well known. Usually AAA to A are the best ratings, while ratings below BBB are classified as junk, otherwise known as junk bonds, with D being the lowest quality rating. According to investment researcher Morningstar, since 1926, stocks of large and established companies have returned on average 10% per year, whereas long-term government bonds have returned between 5 and 6%. True, stocks have returned more than bonds, but they are also more volatile, even with short and medium-dated bonds. The risk is lower than that of stocks, so bonds are generally viewed as safer investments. Ultimately though, combining stocks and bonds is what's recommended to build a more stable and well-rounded portfolio. Bonds provide a worry-free stream of income and are among the most valuable tools in your investment kit. Because they pay interest regularly, they are a good choice for investors, such as retirees who prefer a constant stream of income. Whether you invest in short-term or long-term bonds is quite dependent on your individual investment goals and objectives. If you're looking to buy a house or send a child to university soon, you might look into shorter-term bonds. These are best suited if your objective is to redeem a steady, secure stream of income. If your objective is to achieve capital gains, concentrate on longer-term bonds. When interest rates fall, long-term bonds, especially zero-coupon bonds, go up in value. On the flip side, it is a disadvantage if interest rates rise as your portfolio drops in value. Overall, even though 1 to 10-year maturity bonds yield more and are less volatile than longer-term issues, a bond that matures in 1 year is more predictable and less risky than a bond that matures in 20 years. However, the longer you keep bonds, the higher your annual returns. You can also sell or trade a previously issued bond to other investors in what's known as a secondary market. This proves to be fairly easy because generally bonds do have a good resale value, given that their rating hasn't dropped drastically. As a rule of thumb, when interest rates fall, bond prices rise, allowing you to sell at an increased price. This is a good plus as an investor because it gives you the flexibility to reevaluate and adjust if your view of interest rates change at some point. A fixed time deposit does not offer this opportunity. Remember, the interest payments you will get from owning a bond are fixed, but your return may not be. It's important to consider possible risks related to inflation, changing interest rates, price fluctuations, changing credit ratings of the bond, liquidity and market risks. True, you cannot eliminate risks, but you can reduce their impact if you take the time to evaluate your portfolio mix and align every investment you make with your investment objectives. We at Citi simplify investing so you can get started early. Take the first step, talk to your relationship manager today.